Hey, good afternoon, everyone. Sorry for getting in just a little bit late. Um, just running crazy here, but I've got a lot of material to present, and this is a just an extra session of the battle room. And what we're going to do is we're just going to focus in on how to trade options. At the end, I'm gonna I'll take any questions that you have, and let me just start with our standard disclaimer, that signals and trading opportunities provided orally, written, or electronically, disclosed to visitors or subscribers for educational demonstration purposes only. The company takes no responsibility for profits or losses. And I think everybody knows that that trading any of these markets it can involve a substantial amount of risk, and you can lose a substantial amount of money. Now, hopefully you can also make a substantial amount of money, but the risk is there and you need to be aware of it. Carefully consider your financial position prior to trading. You may want to do your own due diligence. And those of us here at Right Line Trading are not registered financial advisors, and we're not licensed commodity trading advisors. And with that, we're going to go right into our webinar on options. Now, just as an aside, I listened to one last night, and I have to tell you, I learned nothing about options. It was basically a webinar on taking seasonal trades. On John Deere went up 20 out of the last 22 years, and you're going to take a bull call spread every time that that John Deere came up on your calendar. We're going to really take a pretty deep dive, and this is an intermediate level webinar. So we're not going to go into any fluff. We're not going to be talking about what a call is, what a put is. We're really going to be talking about options metrics and how to set up an optimal trade. Now, I need to drop this for 1 second right here, and I need to bring this up and take this over, and because I need to open up another platform in order to do this. So I might as well open this platform up now. Okay, it's open, and let me just go to the appropriate area on it. This is going to help us tremendously. Hang on, it's loading. Okay, we're good to go. Okay, let me put the slides back up. And come right down to here. Now, I mean, just a little bit about myself. I've been trading options, and I've been trading them profitably for close to 15 years. And I've used a lot of different strategies. And I really have, I think, a really good grasp, which I say really humbly, with technical analysis and derivatives and equities, economics and market strategy, and that's really my training. That's a pretty crappy picture of me, but I just put it up there anyway, so you get a little bit of an idea of what I look like. Now, the most important thing in understanding how to trade options is obviously you want to leverage an underlying stock. Now, we're not going to talk about that for the first maybe 40 minutes. All we're going to talk about is option metrics, so that we can decide, once we have defined a stock and an entry, how do we leverage it optimally? How do we pick the best expiration date and the best strike price for my strategy? Now, there may be more than one, but they have to be based on the option metrics that I'm going to go over. Now, trading options is very counterintuitive. And first of all, there's two reasons why. One of them is our mind is constructed to think in terms of linear relationships. I mean, we think of things in terms of linearity, because as far as we can see in nature, everything has a linear relationship. Things don't move geometrically, they move linearly. And if we look at Newton's laws, force equals mass times acceleration, everything in that equation is linear. Nothing is raised to the second power. So that's really the way we're hardwired, and that is basically through natural selection. I mean, that's what helps us survive most in nature, is for us to think in terms of everything in a linear way. Unfortunately, options are nonlinear. Everything in options, every metric in options moves geometrically. So it's a little bit, in some regards, counterintuitive to the way we're hardwired, and we have to change the way we have to change a little bit about the way we think. Now, this is just a linear relationship. So I'm sorry. Here's our linear relationship, and here's our nonlinear relationship. Now, what we want to do when we trade options is we want to use them to leverage that nonlinear relationship. And what we want to do is we want to create this hockey stick type of formation. And you're going to see that this tells us an enormous amount about how the option behaves. And we're going to go over this relationship really in tremendous detail, because every option strategy that you create should have this type of curve. And I'm going to move off the hockey stick, but this is essentially the reason we trade options, is because we're able to use it and leverage it in a really, really powerful way. And the other thing to think about when you trade options is a lot of you out there may use options simply because it's a cheaper way of being able to leverage the underlying stock. Like if you're trading Google, or you're trading Amazon, or you're trading something that's really expensive, you may want to use an option simply to provide you with the ability to leverage 100 shares of stock per contract based on the fact that you have a limited amount of money. But what you really have to do is you have to look at options this way, that if you had an infinite amount of money and you could buy the stock or you could buy the option, and money was not a limiting factor, why would you want to trade the option and not trade the underlying stock? And the reason is leverage. And what we need to do in looking at the options metrics is provide us with the optimal way of achieving that leverage. Now, because I can't draw on this, I drew on the slides before, because I really don't have a nice drawing tool here. Now, let's just look at theta. Now, theta is time decay. And you can see if you go out over a year, and actually, I think we're looking at gamma, which is time decay. And if we're looking at an option over the first 3 months, we get a very small amount of time of decay in terms of the value of the option. In the second 3 months, we get a much bigger amount of time decay. In the third 3-month interval, we get a tremendous amount of time decay. So remember that time decay is a nonlinear relationship, and that's something that we have to leverage in order to create an optimal option strategy. Now, I just drew it out to make it clearer. Now, I'm going to open the chat box. I'm going to ask you a question. Now, obviously, if you buy an option, you want the underlying stock to go up. And if you buy a put, you want the price of the underlying option to go down. Essentially, you want that put to expire worthless. Now, if you buy an option, if you buy a call, let's go to here. We want price to go up. If you buy a put, you want the stock to go down. And let's divide this into 4 quadrants. There's 1, 2, 3, and 4. Now, there's actually 4 directions when we look at options. There's bullish and non-bullish, and there's bearish and there's not bearish. But for the time being, we're just going to look at 2 directions. We're bullish, we're going to buy a call. We're bearish, we're going to buy a put. Now, in fact, let's just look at it a little bit differently. If we're bearish, we're going to buy a call. And if we're bullish, we're going to buy a call. I'm sorry. If we're bearish, we're going to sell the call. So in one particular case, we're going to buy it. And in the other particular case, we're going to sell it. And I hope I'm not confusing you. So if we're going to buy the call because we're bullish, in which of these 4 quadrants would we most want to take the position? Now, this is just rough and conceptual. We don't necessarily want to take the optimal or the one that I'm looking at. I just want to make a point conceptually. If we sell the call, in which quadrant is it best for us to take the trade? So I'm going to open the chat box. Okay, well, okay, the first question I'm going to ask, and I got a lot of answers here. Okay, hold on a second. Is if we buy a call because we're bullish, what quadrant would we most want to buy that call? Okay. All right. The answer is, most of you got the answer right. It's 4, because we want to buy. We always want to buy an option that gives us the most time for it to evolve. Now, let's say we buy an option, and obviously this is just an example, that has a year expiration. Does that mean we're going to hold it for a year? Absolutely not. We may wind up holding it for a month. In fact, we might wind up holding it for 3 weeks. The point is that when we buy an option, we always want to give it enough time to evolve. Now, when we sell an option, where do we want to place the trade in terms of time? Correct. You guys all got it. What we want to do is we want that call to expire worthless. So we want to give it as little time as possible. So if we buy, we want to go to the option that has a lot of time premium. If we sell, we want to go to the time area that has little time premium. And there's the buy in 4. And there's the sell in 1. And like I said, I just put all this stuff on here because I can't draw on this. Now, let's take a look at options buying. Now we have to. This is just an options chain, and I just snapshotted this off of what could be a potentially daunting number of options and expiration dates and volumes and open interest. Now, if we take the call and we want to buy it, we have 2. I just narrowed it down to 2 expiration dates. We have the June 26th and we have the July 10th. One gives us 15 days to expiration and one gives us 29 days to expiration. Now, what's intuitive is if we buy something, we want to buy it as cheaply as we can. So if we go by our basic intuition and we're bullish on Apple, we're going to buy, and we know our strike price. We believe that Apple is going to eclipse 355 right now. It's at 354.26. So we're buying an at the money option. And I'm also going to show you why an at the money option is without a doubt the best strike price to take in almost every circumstance. It's going to cost us $8.25. If we go for an option that has an expiration 29 days out, we have to pay $11.20. Now, intuitively, we're going to buy the option that has the cheapest price. But when we put this into our tool to determine the probability of success, we're going to find that the more expensive option is going to give us a better probability of getting a winner. So if we have to choose between two strike prices, when we buy, we're always going to go for the option that has the greater time premium. This has a better chance of evolving into a winner. And remember again, just because this has a 29 days to expiration does not mean we're going to hold it 29 days. We may wind up only holding it a week. So all we want to do is create an options configuration that gives us the best chance of getting a winner. And the option with greater time premium is going to put that in our favor. Now we're going to look at just the opposite. Now we're going to look at the sell of the option. Now, you have 2 prices. You can sell at $4.40, or you could sell at $6.70. And when you sell something, again, it's counterintuitive. What you want to do is you always want to sell something and you want someone to buy it from you at the most expensive price. So you're going to look at Apple and you're going to say, you know what? I'd rather sell the $6.70. It's got more time premium, but I'm going to make more money if it evolves in my favor. Here is the shorter term option. I only get $4.40 for selling this particular position. So intuitively, you would opt for selling the longer term. But when it comes to selling an option, you want to sell the option with the shortest time premium. So you're going to sell the $4.40 and not sell the 670. And the thing that you can do is this. If you sell of the 440, you can just sell 2 of them. And what you're going to get when you sell them is $8.80. If you sell one option at 670, you're going to get 670. So you're really only paying a little more for leveraging 2 calls that you sell over leveraging 1 call that you sell, and the probability of this becoming a winner is exceedingly higher than your longer dated option. So we're going to remember that if we buy, we want to buy a position that has more time premium. If we sell, we want to buy an option, or we want to sell the option that has the shorter time premium. Now, I'm not going to go into calendar spreads, but that's the whole underlying theory of creating a calendar spread. And in the next options class, where we go into advanced setups, you're going to see how calendar spreads can be extremely lucrative. We're just going to be talking about puts, calls, and verticals. And we're also going to look at covered calls. We're going to look at a lot of positions. So now let's look at gamma versus delta. Now, delta is the amount of money the underlying option changes in price for any incremental change in the underlying stock. And this is these 2 concepts are probably the 2 most important concepts that you have to master. Now, if you buy a deeply in the money option, your delta is going to be approximately 1. So for every buck that the stock goes up, you see how the delta drops all the way down? So that it's telling you that for every dollar incremental increase or decrease in price of the stock, the price of the option is going to rise or fall a buck if you're deeply in the money. Now, how are we leveraging the option this way? And we're not, what the bottom line is, we're not leveraging the option at all. If we buy a deeply in the money option where the gamma is all the way down here, and the gamma tells us the change in delta, and the delta essentially tells us how much the option is going to change for every incremental change in price of the underlying stock. If we buy deeply in the money where the gamma has come all the way down close to 0, we're not using leverage at all. Again, if the stock goes up a buck, the option goes up a buck. If the stock goes down a buck, the option goes down a buck. We have no leverage on the trade whatsoever. If we traded deeply out of the money, we have the same thing. For every buck that the stock goes up, we have almost no change in the delta. So we're going to make very, very little money here. Here we're in lockstep, $1 for $1. Here we're in lockstep. We basically make almost nothing. So essentially there's no leverage if we buy a deeply in the money or a deeply out of the money options position. Where what we want to buy, now the stock price is $25. So what we want to buy is an option with a very high gamma. The gamma means that for every incremental change in price, our delta is on that curve. And the delta is what gives us all of the leverage. Now, I know this may be complicated, seem complicated at first, but if you take a look at what I'm saying, I can show it to you here. Here's an in the money. Here's an at the money, and here's an out of the money. So if you're buying in the money, the delta is high. For every incremental change in price of the option, you're gonna get almost lockstep a nice change in price in the option. If you buy an at the money, the delta is moderate. And if you buy an out of the money, the delta is low. And the reason is because of the gamma. Here, the gamma is almost down to 0. And here, the gamma is all the way down to 0. So you're not leveraging the option to change in price significantly as the price of the underlying stock moves. Now, the in the money is expensive, the at the money is moderate, and the out of the money is cheap. So here's what we want to do. Let me just go to the next slide. Hold on a second here. I don't think I included it. Here's what we want to do. We do not want to buy an option where the gamma is low. And the gamma tells us how much the delta is going to change for every incremental change in price of the underlying stock. If the gamma is low, this delta is high and it's going to stay high. If the gamma is low, this delta is low and it's going to stay low. If we buy an option where the delta, where the gamma is high, I can find my cursor. Hold on a second here. It just vanished. Hold on one second. Oh my gosh. I think my mouse just ran out of batteries. Just give me 2 seconds and I'll replace them because my mouse is dead. Hang on 1 sec. Just excuse me 1 second. Things like this always happen when you're right in the middle of something. But Sergio's looking at my mouse here. Yeah, it just started flashing, Sergio. I just saw it. Yeah, you got it. All right. Thank you. Okay, we're back. So just getting back to what I was saying, the reason we buy an at the money is because we have a high gamma. And the gamma means that the change in delta, or the change in amount of money that we're going to make as the stock moves in our direction or out of our direction, is optimal. And let me show you what I mean by that. Now, if we buy a stock that has a gamma like this, and if we go back, you see how the gamma works at the money. The gamma is the blue line. We want the gamma to go up in this curve. And that curve tells us that the delta of the option is also going to move up like this. So as the stock moves in our direction, the amount of money we make per incremental change in stock is really going to go up nicely. And what we're going to get is this hockey stick formation on the price of the stock. And if the stock goes against us, gamma is going to fall, and eventually we're going to lose pretty much all the premium, but it's going to limit our downside fairly quickly, unfortunately. But if we buy, I didn't make curves for buying a deeply in the money or deeply out of the money. A deeply out of the money is not going to have this kind of curve. A deeply in the money is not going to have this kind of curve. And this is the only kind of curve that's going to provide us with the leverage that we need in order to really make money when we trade options. So the best options choice is either slightly in the money or at the money. And it all has to do with the gamma and its effect on delta. And we also know that time decay plays a factor, and that's also working in our favor. If we buy deeply in the money, obviously time decay is going to be minimal, but we're going to pay a lot of money. Deeply out of the money, it's going to be cheap, but the likelihood of getting a winner is going to be extremely small. So we balance out everything by buying an at the money or slightly in the money position, or slightly in the money call. And we do that in order to create the leverage we want. This is why traders use options. If you want to buy it deeply in the money, you might as well just buy the stock, because for every dollar the stock goes up, the option goes up $1. Now, obviously, you're going to make more money on the option, but you're not using the leverage that you can get with an option. Now, also, if you buy a deeply out of the money, then, and actually, I actually wrote these wrong. This is the out of the money, and that's the in the money. But it doesn't make any difference. Either one of these are bad choices. If we go out of the money, we're not going to get the leverage that we want. Now, and that's the kind of leverage we need. So if we buy a position, we want to buy a position that's, let me just take a look here. hold on a second. So here's the curve I was looking for. Here's what happens if we buy a deeply in the money option. We have the delta and we have the gamma moving in lockstep. No leverage. If we buy it deeply out of the money, we have the delta and the gamma moving in lockstep. No leverage. If we buy an at the money, right here, here's where we have the delta moving up geometrically as the gamma moves up geometrically. So that's how we want to look at trading options, and that's why we want to look at these kinds of positions. That's why we want to buy a position that's more expensive and sell a position that's cheaper. Now, what does the delta tell us? The delta tells us the probability that at options expiration, the price of the stock will be at the strike price. Now, right now, Apple's at $354.26. Now, this has a delta of 25, the $375 call. And that tells us that we have a 1 in 4 chance of getting the position to our strike price before expiration. Here, the delta is 10. And if we buy a position with a delta of 10, we're only have a 1 in 10 chance of getting the position to the strike price before options expiration. So the delta actually gives us some really good information about the probability of the trade being successful or not. Now, if we buy an at the money, the delta is going to be very close to 50. So we're going to be buying a position that has just taking the delta into consideration, about a 50-50 chance of giving us a successful trade. The further down we go, the lower the probability. Now, and here's really it sort of summarized. When you buy the longer dated. You buy the 1 month or greater. When selling, you buy the shorter dated or the less than 45 days. Remember, it doesn't mean you're going to hold it that period of time. And we're going to talk a lot about buying weekly options in a minute. But remember, you can take any of these options because of the leverage that we have, because of the fact that we're right at the inflection point of the gamma and the delta, that if we get a 2, 3, or 4% move up in the underlying stock, we have a potential of making a lot of money on the option. So we do not have to hold these options to expiration. So when you see all those sort of phony, get your weekly paycheck, it doesn't necessarily mean that you are buying or selling weekly options. Now, when you're selling, you're going to buy, the strike prices when you're buying, you're going to buy at the money or slightly in the money. When you're selling, you want to buy out of the money because you want to buy positions that are going to have a very high likelihood of expiring worthless. You have a very poor gamma, a very poor delta, and you acquire those by moving the position to out of the money. So let's look at some income strategies. Now, if you buy a covered call, and I doubt that many of you do this, but it can be very lucrative. Again, you're going to buy a call, so the expiration is going to be longer. But when you're buying a covered call, You want the delta to be far out of the money because I'm sorry, you're going to sell a call. I am sorry, because you own the stock, so you're selling the call. So you're going to take a very low delta and you're going to take it far out of the money. And you're going to take a position that has a shorter term expiration. That's the only way to get this delta and the only way to get a really poor gamma. So the likelihood of getting a winner on this position is very low. Now, the best way to trade covered calls, I didn't really write this out, is, well, actually, that's the best way to do it. Now, you can sell a short put, and you can do it in a cash secured way. In this particular case, like, you don't own anything, you just want to sell a put. Now, if you do this, and I used to do this all the time, I used to do this with Google. Now, it's very, very risky, but the best way to look at this position is because it's a short put, the expiration is still going to be 30 to 45 days, because your strategy here is you want to own the stock, but you want to own it at a cheaper price. So you buy it with a delta of about 40, which is slightly out of the money, in the hope that the option, and when you sell a put, you're actually buying a bullish, you're creating a bullish position. So you're going to take a little bit of a loss on the position because you want to buy the underlying stock at a discount. And if the stock goes up, you make money. So I hope that's clear. I mean, I maybe should have thrown in a lot more examples, but these are two positions that we in the battle room are not going to really look at. We're not going to look at selling a naked short put that's cash secured, in which actually what we want to do is own the underlying stock. And we're not going to be selling covered calls where we own the stock and we're concerned that the stock is going to fall and we want to make money from the fact that that stock is going to retrace. These are going to be what we're going to do mostly. We're going to buy a call or a put, or we're going to buy a debit vertical spread. Now, if we buy a call or a put, the expiration is going to be fairly far out. Remember, we're buying these positions. We're not selling these positions. So we want that inflection point. We want that leverage. So we want our strike price to be right there. We want our in the money. We want it to be in the money, at the money, or slightly in the money with a delta of between 50 and 60. That's going to give us great leverage when that gamma skyrockets as this moves up. Now, again, we may not hope, our hope is we're not going to be holding these 45 to 60 days. Maybe we're going to be holding them a week. Maybe we're going to be holding them 2 weeks. But we're looking upon them as a short-term position. And the only reason we're taking a 45 to 60 day expiration position is to have the ability to leverage them in the appropriate way with delta, theta, and gamma. Little time decay, great leverage with the gamma skyrocketing, which increases the delta significantly for every incremental increase or dollar increase in price of the underlying stock. Now, buying debit vertical spreads is very, very lucrative. Again, you're buying the position. So you want 45 to 60 days. You want plenty of time. You want the buy position, the position that you buy, to be exactly like any other position. 50 to 60 delta, slightly in the money. The position that you sell, you want to have a very poor delta, i.e. a very poor gamma, and you want it and you want it to be far out of the money. You want that option essentially to expire worthless. Now, if you buy a deeply out of the money position, it's going to have a theta that's very high. This is going to decrease in value quickly, which is what we want. So let's say the trade just kind of languishes and it just sits. Now, time decay is going to affect the leg that we sold far greater than it's going to affect the leg that we buy. So essentially, if we buy a vertical spread and the price just sits for a while right at our entry price, we're actually going to start making a small amount of money because the leg that we sold is going to start to decrease in price very rapidly because it's way out of the money and it's going to be affected by theta or time decay very, very quickly. So that's going to help us. In addition, when we buy the vertical, it's going to help offset the price. Now, it does limit our upside, but it also limits our downside, and it makes the position far less risky. And it puts everything in our favor. The option that we want to expire worthless expires worthless quicker than the option that we want to move up. So if it sits, we're great because we are going to start to make money. That's another reason why if you hold for a week or 10 days and you just get maybe or 2 or 3% move to the upside on the underlying, you have a potential here to make a nice percentage because theta is going to basically destroy the short leg and you're going to have gamma really push the delta up of your buy leg, and you can make a really nice percentage on a vertical spread if you stay with these metrics. And I really like vertical spreads because they sort of give you the best of both worlds. They give you that great hockey stick formation on the delta because of the gamma, and they really destroy the leg that you sold to create a really advantageous position. You limit your upside, you also limit your downside significantly. The position you acquire is diminished in price, and it really gives you the best of both worlds. Now, I'll just talk really quickly, because I don't want to go into it in a lot of detail, is about a calendar spread. And let's say you want to buy an option, you want to take a buy leg that's a year out, and you believe that the stock is going to slowly drift up in price. You can, every month, you can sell the leg, it'll expire worthless, and whatever you paid for the leg, or whatever money you got when you sold the leg, you're going to collect. So if you have a 12-month position, every month from 1 through 12, you can collect money on the leg that you sold if the stock slowly drifts up, as long as it doesn't come down. And so calendar spreads can be very, very lucrative, and you can wind up getting paid every single, you can buy a weekly here. This is where buying a weekly is not unreasonable, but I'm going to talk to you for a minute later on about why buying weekly options is extremely risky. I would buy a monthly and I would get a paycheck every month on buying a calendar spread. but you know all the underlying numbers, all the underlying, the way to configure the trade based on the vertical. But let's say we have a vertical with an expiration of, say, 280 days. If that vertical goes in our direction, it's going to take a long time for it to gather speed. So while we're waiting for it to gather speed, we just sell a leg and collect a check, every option, every month on the option's expiration. Now, when you sell a credit vertical spread, I'm really not going to go into a lot of detail on these, because selling a vertical really puts you in a lousy position because of the way you have to configure the deltas. The optimal deltas don't give you a great amount of leverage, and they make you take a lot of risk on the trade. So all I will tell you about selling a credit vertical is it's not something that we're normally going to take, simply because the configuration simply doesn't provide us with an optimal way to leverage delta and gamma. So we're going to stand aside on selling a credit vertical. Even though we get the money, the strike prices and the gamma are not optimal. And so we're going to stay away from these positions. Now, I want to talk to you for a minute about hysteresis. And I'm sure it's a term that you probably have either never heard before or you're not familiar with. Now, hysteresis is the phenomenon in which the value of a physical property, no matter what it is, lags behind the changes in the effect causing it. Now, it's derived from electrical engineering or mechanical engineering, because it originally arose from current that moves around a current loop. And when magnetic induction lags behind the magnetizing force. But we can use it to our advantage when we trade. Now, we're always looking to trade in the direction of institutional money. And that is going to force price in the direction that we want it to go. But price is also subject to hysteresis. So sometimes price will lag behind the actual direction of institutional money. It's simply a physical property that we cannot get around. Now, the amount of hysteresis that's present in any closed system, whether it be the stock market or in this particular or in a current loop, is always variable. I mean, you can develop an equation that calculates for you the average amount of hysteresis that you're going to encounter, but at any given moment, hysteresis changes. Now, if the physical property of price movement sometimes lags behind the changes in the effect causing it, which is the movement of underlying money in the direction, that's what makes buying or selling a weekly option extremely dangerous, because we can get that lag. Now, we know how difficult it is to call a direction in price. Now, if hysteresis is an intrinsic property of the stock market, and it's an intrinsic property of every closed system, we just may not get the movement in price we want, even though the underlying force has aligned in the direction that we want it. Also, there is some intrinsic wobble in every market. So we have those two forces that work against us when we trade weeklies. Now, so I really don't recommend them as a general way of trading, but you can get a weekly paycheck at a much safer, in a much safer way, by either creating a calendar spread or simply creating a vertical spread that just moves in your direction if you have multiple verticals in your portfolio with different strike prices, you can collect those strike prices either weekly or bi-weekly very safely, and it's much easier to trade than trying to take a weekly. Everybody, I mean, I watch all the options that cross the ticker, and there's a lot of option sweeps that take place on weeklies, and a lot of them lose. And the traders that take weeklies are usually very wealthy, or in all honesty, they're very stupid, because in the course of 5 days, it's very difficult to, with a tremendous amount of certainty, determine the direction of an underlying stock. And there are two physical properties that tell us why. And one is hysteresis, and one is the fact that there is intrinsic wobble in every stock. And also, nothing prevents the stock from taking a very, very short-term retracement. Doesn't continue. If you're looking at a bullish position, it could still retrace. So those short-term positions, unless you got millions and you're willing, it's really a casino bet. You're going to pay a very, very small amount of money for a potential 300, 400, or 500% winner. I've taken them before, but I really don't like to do it, because essentially you have no time premium, and because you have such a short-term option, you really don't have much gamma and you don't have much delta. Actually, you have a lot of gamma and a lot of delta, but you don't have much time premium. And theta is going to erode that option so badly. If it doesn't move in your direction quickly, you're in big trouble. Now, here, essentially, as I tried to pull a thing off the internet. So, and what it tells you is the center is where you anticipate the stock price to be, right here, this A curve. But because of hysteresis, intrinsic wobble, and the fact that you can get a retracement on any financial instrument, it could be as far up as C or as far down as G. And there's no way you can control it. So taking a weekly is very, very dangerous. What you want to do when you buy a position is give it plenty of time premium, buy it at the money, use that hockey stick leverage to give us a tremendous amount of leverage on the trade. Gamma is going to skyrocket, delta is going to skyrocket. Those are the kind of positions we want. We buy a vertical, we want to sell the position, we want to sell it deeply out of the money, we want theta to erode the price, and we want gamma to be low, so delta's low. So the price of that option that we sell has a very high probability of expiring worthless. That's what we want it to. We want to keep the premium, and we want that to expire with zero value. Now, what determines the liquidity of an option? And I believe that this is probably the most misunderstood metric of all. When you look at an option, and I just picked Goldman Sachs, and I'm actually going to show you this platform because it's not Thinkorswim. It's a lot easier than Thinkorswim. It doesn't provide you with quite the information that Thinkorswim does. But for a lot of you as beginning traders, or hopefully you're in the intermediate zone, I really like this platform. I'm going to show it to you. Excuse me for a minute. Now, it's not open interest, as most traders think. I mean, open interest has nothing to do with liquidity. The liquidity of an option is directly proportional to the bid-ask spread. If the bid-ask spread is small, and it should be 1% of the underlying stock or less, then you have a lot of liquidity on the position. If the bid-ask spread is high, greater than 1% of the underlying stock, you know liquidity is poor. And one of the things that you do not want to do is create a position, especially a two-legged position, potentially a three-legged, although I take very few three-legged positions, where you can't get out and where you don't have a lot of liquidity. You need liquidity to move in and move out. And market makers are always going to be there to try to spank you and shellac you. So you need that liquidity. I mean, I can't tell you the number of times I've tried to sell, say, an option at $3 or sell a spread at $3, and it's sitting at $3, and the market makers don't want to give it to me, even though I'm selling it at the price it's selling for. They just don't feel like it. And a lot of that has to do with liquidity. So don't buy an option spread or a call or a put unless the bid-ask difference is less than 1% of the underlying stock. Now I'm going to move over to the platform. Take this out. I hope I haven't confused you. I mean, listen, if you really do an options webinar, it's not easy. And very, very few master classes actually do teach you this. What they do is they teach you some gimmick. Now, let's say that we want to take a trade, and let's look at Facebook. And we're going to say we're bullish on Facebook. Now, this is going to give you the optimal positions that you can take. Now, it's going to default to 1 month. And you can see the technical score here is 9. So the uptrend is very strong. But we don't trade off of this platform. But this does configure our metrics for us really well. And here's how it does. If we buy the call, now the 72 is in red and circled, which means it's a poorly configured position. And we can modify it, but let's take a look at the vertical position. Now the vertical position has a blue check after it, which means it's a stellar position. Now if we click it, it gives us all the metrics. The cost of the position is $1,230. The maximal reward is $2,270. So our risk to reward is almost 2 to 1. Not quite, but close. Now, the probability of this being in the money at options expiration is 33%. And actually, that's quite good. And the days to expiration are 45. Now, let's say we want to get deeper inside this position. It's this magnifying glass. And the magnifying glass is telling us all the information that we already got. But what we can do is we can click here and it's going to explain the Greeks. And it tells you that this is a bullish strategy with limited risk. The risk is 1,230, limited potential reward of 2,270. And the strategy will profit if the stock closes above 247. There's a 33% probability this will happen. And here's the delta. The delta is 38. The gamma is 32. The theta is 8.08. And I don't even bother with the vega. So all in all, it's telling you that for every dollar Facebook increases, it will result in an increase in the spread of $38.84. But due to time decay, if it just sits where it is, it's going to lose $8.08 every single day as expiration approaches. So it gives us all the metrics that we want, and it gives us the optimum trade. So we go backwards on this, so we just go to the 90, and I'll answer all the questions. Now, and here's the trade. Now you can see the bid-ask spread. It's very, very tiny. The bid's $11.23, and the ask is $12.30. So it's about $1. But the underlying is 200 some odd dollars. So it's not even close to 1%. So this is a tremendously liquid position. Now let's go back to let me scroll back. I'll just put Facebook back in here again. Let me check this out. Here we go. Now let's say we want to modify the trade. Now this is giving us the optimal 1 month strike. Let's say we want to trade a 2 or a 3 month. Okay. Now the strike price is at 235. So normally that's exactly where I would buy. Remember, you want to buy a position that is at the money, and this is automatically giving you an at the money position. But let's say we want to keep it at 235, but we don't want to trade the July. We want to trade the August. And let's say we don't want to keep this at July. We want to move this to August. And now we have the metrics on the trade. Now the trade is an August vertical. And if we look at the metrics, it's still got a 96 score, still very high. Now, our expected profit is $22.50. We're looking at 180% return. And if we go to the Greeks, we can see that we've increased the probability of a win from 33% to 34%. And we're going to lose less in time as each day passes. And I'll get to all the questions. So we've actually optimized the position by taking the trade out 2 months versus 1 month. Now we can go back again. And let's say we want to do a 3 month. Now we have to buy an at the money. And let's go to September 18th. Now, in essence, if we keep this in August, we're selling a calendar spread because we can sell the August and then we can sell the September, or we can go back here and we can sell the July, which I think is the monthly. And what we're going to do, we're only going to get 80 cents if this expires worthless, but it's very likely to expire worthless. So this is, I don't even want to look at the metrics of a calendar. Let's just stay with the vertical, and let's take the September 18th, and let's take the September 18th here, and look at the trade. The score is now 92. And if we look at the Greeks, we now about the same, 34% probability. Look at what happened to theta. Now we only lose $289. Facebook is going to increase by $30 in profit for every dollar that the stock goes up. Now I don't remember what the last one was, but I'm sure that this is decreasing because we're moving out of the money. Now the delta is diminishing, the gamma is diminishing, and the theta is diminishing. Time decay is less, but our hockey stick leverage is getting a little looser because we're taking a longer term time frame option. And now let's just look at just buying a call. Now, this is really expensive. And if we look here, and let's just take this out here. And just look at this trade right here. Here, if we look at the Greeks, it's a bullish strategy. There's unlimited upside with limited risk. You can lose $23,000, unlimited profit potential. If the stock closes at options expiration above 235.70, you're good. You have almost a 50% chance that this will happen. And for every dollar that Facebook increases, this is going to increase by $1. $1, $100 in profit. So, I'm just showing you all the configurations. Now, I'm going to go to questions. Now, this is the option scanner off of First Trade. Let me close it for a second. And the reason I like it is because it's simpler than the one off of Thinkorswim, and it gives you a lot of configurability without a lot of the difficulty. I mean, Thinkorswim does give you a little more information, but when you're first starting out, this is really all you need. And I really like this platform. Now, this is as far as I'm going to go in this webinar. There's a lot of information here. I hope I was clear. Now we can see right now the Dow's up 640, the Nasdaq's up 198, and the S&P's up 71. And we're doing really, really well. Now I don't have any positions in here. I have all my positions in Thinkorswim. So you're not going to see what I'm trading. I'm not hiding them. I mean, I can tell you our positions. But I want to take a look at one position. Let's go back to trading. I'm going to go to options. And we're going to go to the options wizard. And we're going to look at it's Norwegian Cruise Lines. Here it is. Norwegian Cruise Lines. Now you can see we've been holding on to it for a while. And it's come up. It took a big pullback and hurt us. And now it's starting to come right back up again. Now, we didn't take it at this point. But all I did was buy a call on Norwegian, a long-dated call. And what I really regret was not creating a calendar position, because we would have cashed out multiple calls that we had sold and made a lot of money already on the Norwegian position. Because when it made its move up here, we could have really made a lot of money right here. And even though it might have come back against us, we only would have lost a little bit of money. We really could have made great money. Now, this Norwegian Cruise Lines position doesn't expire until 2011, and we're up a ton of money on it. And it already has acquired a really high delta, because it's way above the price we entered it at. It's got a heck of a delta and a heck of a gamma, I can tell you, and it's just a call. So let me go through the questions. I know it's a lot of information, and I just hope I was clear on this. But this is what we're going to look for. Remember, to get an optimal entry is one thing, but understanding what to do with it after you get the entry is another. Now, if the price of the underlying call is cheap, we can just buy a call. But just because we buy a vertical doesn't mean that we're not buying a very short-term position. If we buy a 30-day vertical, we may wind up holding that 30-day vertical for 7 or 8 days. If our upside target is 50 to 75%, we'll set our sell price already. So if it just nicks it and takes us out, we're out of the position. Now here, we have that check. So we know that's the position to trade. The cost is $285. Look at the reward, $615. I mean, that's the best potential trade. And if we want to look at the underlying, go right here. Expected profit is $533. The return is 187%. Target price is $29.18 in a month. And if we look at the Greeks, we'll see that it's a bullish strategy. We can only lose 285, but we can make 615. That's better than a 2-to-1. Once the trade once Norwegian closes above 23.85, we're making money. A 30% probability is a good probability. And on this position, this is a good delta. This is a good gamma. Now you'll notice that the delta is very close to the probability that the trade's going to work. Remember, I told you that. They're not going to be identical, but they're very close. So I hope this all makes sense. Like if we wanted to go into Norwegian and we got an entry, we would run over here and we would have this open. And we would simply put the price that Norwegian was closing at, it was at right at the time we wanted to take the trade. This is just where it is right now. And it would go right into the generator. And this is what we would get. Now, the check is always a terrific trade. And the risk to reward here is amazingly high. We're only trading a 1 month out, and we could literally hold this for a week or 10 days. And we've significantly limited our risk. Our cost is $270. Our maximum reward is much higher. And if we look at right here, look at the Greeks. We got a 31% probability. Here's our risk, and here's our reward. A little under 2-to-1. And that's a terrific risk to reward. So I hope this gives you some contextual understanding of what we're looking to do. I mean, day trading options does not mean you buy a call, hold it for a minute or 10 minutes or an hour, and then sell it. Because if you do, you're going to accrue substantial risk. Now, you can do it, because if you buy an at the money, you're leveraging the delta and you're leveraging the gamma. And you're also minimizing theta. So you have very little time decay. And remember, you can buy that single option either on a weekly or a 2-weekly, or a 3-weekly. It's really, really up to you how much risk you want to get versus how much reward. The smaller the time premium you buy, the cheaper the option. And you can't lose more than the cost of the option. And right now, if we wanted to buy a call on the position, the recommended right here and at the money, the trade is 100. It's a $20.86 between $20 Very, very good liquidity. The bid to ask. And if we look at the metrics, look at the Greeks. Now remember, this is looking at a month, but we can change that to a week, and I'll switch it to a week. The probability is of 40%, which is really good. Now, let's go back and modify the trade. And, oh, I'm sorry, it's right here. I'm sorry, I screwed it up. Here's the call, here's the stock. So here's the call. And if we look at the Greeks, we're looking at the risk is 410. A break even is 2460. There's unlimited profit. And there's about a 26% chance we're going to get the trade. The delta is very high. The gamma is very low because we're looking at a monthly, and the theta is very low. This is the kind of trade we want to take, but we can modify it. Instead of buying this may be a weekly, you know that. It's looking at the weekly. It actually defaulted right to the weekly, and that's exactly what we're looking at. And this is what it is calling as the optimal trade right here. And that's what we're getting all this information off of right here. Delta at 50. Theta is going to be high. It's a weekly. Gamma is going to be very high on a weekly. For every dollar price, you're going to get $7.86 on the change in the option. It's a lot. And the risk on the trade is 195 bucks. And in this particular case, we just might pull the trigger on the weekly. So I'm not going to go any further, and I am going to go back to the questions because I know there are going to be plenty of them. And either way, I hope I gave you some insight into trading options that you've never seen before. But this is what we're going to look at in the battle room. I mean, we're going to look at live trades evolving to perfect entries, and we're going to use this tool to give us a quick analysis. And if you want to take the trade, obviously I can't take it on this platform because I don't trade this platform. I have a few $1,000s in it, but I don't trade it. And I think you can see how much money I have in here. But I love this tool as a quick assessment. And if I wanted to trade it, all I would have to do is hit that. And what it would do is it wouldn't give me the bid, it wouldn't give me the ask, it would give me the midpoint. And that's always what I want to try to trade. I want to try to trade the midpoint. You're always going to get filled when you buy at the ask. If you sell, you're always going to get filled at the bid. We want to try to get the midpoint. And if we get executed, we're going to be in good shape. And this is one contract, 21 strike on a call. And that's an at the money, because we are trading right here at 21. Now, I would have liked Norwegian to go up a lot more. I would like to see a 10 to 15% move up on Norwegian. And you can see it gapped up here, and then it's retreating. I mean, we had Norwegian as high. It was really dumb not to take it off when it was 26, 27. But we've got a real long amount, a lot of time. The one that I really hope I didn't blow completely was Smile Direct. I mean, we had this all the way up to $10 on a $7.50 call. It's heading back up, but this is not a trade we would take. See, we've got 3 reds all the way across. Even if we got a signal to enter this trade, the options metrics are extremely poor, and we need both. We need good options metrics, and we need an entry. Now, it's up 5%. I would have liked to see Smile Direct up a lot more. And I want to see it go back to 10. I mean, I really blew it. I should have taken this option off. Two opportunities to take it off at 10. Here and here. Formed a double top. And now it's retraced. But hopefully I can still get it at 10. I may take it off at 9 if I get it. All right, so let me go to the questions. Let me hit the escape key here and close and just go right back. I'm just going to open it, and it's just going to be on neutral. Okay, it's going to be on Smile Direct. We can put it, we'll put it on. We'll just put it on Facebook. And there's our trades. So the only trade that we could potentially take on Facebook, if we got a great entry, would be a month-long vertical. Now, I'm sure we have plenty of time, but we could always look to modify and make this number bigger. And I know we could. We're looking for 170.24% return. So it's not exactly a 2-to-1. I know, and we could modify it if we want by just taking it out. Now look, listen, this is giving us the weekly, which it normally does not do. We can move the expiration out right here to August, and we can look at the underlying wherever it is here. Let me find it. And we can look at the Greeks. And here's the August. So I think you get the idea. So we can actually modify this just by going this way. There's December, January. And it goes right to the weeklies. So it goes to the weeklies, to the monthlies, gives you the whole chain. And this, obviously the strike price, you can just play around with it, and you can watch the curve. Look at the upper right-hand corner. And you can see right here that there's your optimal. And it's actually a 220 and a 245. So let me answer any questions. Like I said, I hope I made all this clear. I mean, this is, I mean, there's no gimmicks here. There's no finagling. There's no buying, options based on a seasonal pattern. We're trading options the way they are meant to be traded. I'm looking at the 3 major metrics: theta, gamma, and delta. Those are the 3 important Greeks. This does all the calculations for us, and we can really play around with it, and we can try to optimize it. But usually when you get that check, you've got a very, very nicely configured trade. But we can always try to make it better by modifying the expiration. See, that we lost the check. We go back. Well, we lost it. Don't know where it went, but we lost it. So we're going further and further out. And you can watch the probability of winning. Now we're on the July 24th. Now the July 30. We're right around 46%. It's not changing. Okay. And the 215, 240. You can look at the Greeks on that. We need 230 for break even. So ready above that. It's a 50-50, which is excellent. Our deltas, okay. Our theta, excellent. Our gamma, not so great. But the probability and chance of winning is terrific. But you see the potential reward is only 965 bucks and the risk is 1,535. So you never want to take a trade like that. All right, let me go to the questions. Okay, guys. You got it, Robert. You guys are right on in the right quadrant. Yeah, you're absolutely correct, Robert. If we go back, it would be better to sell the 440 twice. Aha, saw that coming. Us math guys and our Russian brides. Thank you, Robert. I'm waiting for mine. You haven't sent it yet. Hey, Eric, why would be day trading of very liquid options like the SPY? Well, remember, Eric, day trading a position doesn't necessarily mean that you have to buy a weekly option. That was the only point I was trying to make. You can move into the option and out of the option in one day, but it doesn't necessarily mean that you need to trade a weekly to do that. You can move into the option and out of the option in one day based on buying a 2-week or a 3-week or even buying a vertical. Remember, you're always buying the option where the delta and gamma are maximal for you. So you're going to get a big bang for your buck if this underlying stock moves in your direction. All you're doing by switching around the configuration is simply switching around how much you have to put up for the position, so how much you're risking, and what your potential reward is. So if you want to buy a weekly call, say on the SPY, it might be very expensive. But if you want to buy a weekly vertical on the SPY, it may be it's obviously going to be far less expensive. If you want to buy a 2-weekly, something that expires in 2 weeks on the SPY, that's going to be even less expensive. But your delta and gamma are still going to be so much in your direction that if you get a buck or two off the SPY, you're going to make great money. So all you're doing is preserving your capital in the potential that it goes against you. And remember about hysteresis. You always have the possibility of walking into a retracement. And on a daily, remember, when you're at the money, you're going to quickly acquire gamma. So as it moves against you, it's going to move against you, and it's starting to, that snowball starts off small and then it gets bigger and bigger. So that's how you get the hockey stick against you. So it's going to quickly flatten and you're going to hit your maximal loss. But that's all you're trying to do. Okay? No, there's no argument, Eric. You and I agree. You can easily take a daily position. It's simply a matter of configuring that position in the best way that gives you the best bang for your buck with the best protection that you have on the most limited amount of money you need to put up and leveraging it optimally. And you can be in the trade for 15 minutes and still make great money. Now, obviously, you're going to make the most amount of money if you buy it at the money weekly, but you're also taking the biggest amount of risk if it happens to retrace against you. I mean, you may go to maximal loss very fast. So it's just all a matter of capital preservation. And honest to God, there is no right way or wrong way to do it. All I'm laying out for you is trying to show you the metrics. So when you take a trade, you understand what you're doing. If you realize the risk you're accruing against the potential reward, you understand the gamma, delta, and theta, and you take the trade. You're an informed trader. You're making an informed trade. You understand the risk reward. Then it's a good trade for you. Okay? So, I mean, absolutely no argument here. Hey, David, what I'm interested to know is how to use your stock charts. Okay, well, remember, David, in this particular webinar, this was not to look at the charts and trading. This was an add-on webinar that I did for traders in the battle room. It's supposed to meet every other week, but I wanted to throw that in because we're going to do a lot of day trading of options. But and obviously we're going to use the software big time, but that just was not the purpose here. That's all. We're going to get to what you want, but that wasn't the purpose of this webinar. That's all. Right, if you buy the stock, correct. Hey, Mark, thanks on this option teaching. Could you perhaps send us the presentation to further review each week? Sure, you're all going to get this on a link, everything. But I really think to trade stocks, you need a deep understanding of those three Greeks. I mean, you can't calculate how they interact. You need a tool to do that. But you have to know why you're buying an option at all. And you're buying it for the leverage you get at the money or slightly in the money because of gamma and delta. And you have to know that the more time premium you have, it's going to be more costly, but you're going to minimize theta. So you have a lot of opportunities. Theta really begins to erode your option. You're trading a monthly in that last month. If you're trading a weekly in those last couple of days, it really just starts to destroy and erode the value of your option. Whoops, sorry here. Let me just go backwards. I just hit it by mistake here. I'm sorry here. Here we go. Hey, Eric. What length of time are you expecting to be in these trades? If we day trade them, Eric, we're going to be in these trades for an hour or so. That's it. We're going to be in and out. I mean, I'm going to show you, I'm going to show you some, I'm going to show you a little bit of an offer that's very inexpensive. But what we plan to do is just day trade. But we want to be able to, what our plan though, is to take the most advantageous position to maximize our profit, but also protect our downside. That's our goal. I know nothing. Okay. I think Patel, you really need to join a service that provides you with some kind of tool like this. I happen to like this more than Thinkorswim for the beginner or the intermediate. If you're a really advanced, that's the reason I have Thinkorswim. I could have opened it up. But I like the way it's a much more simplistic analysis. It allows you to take the trade. And like I said, I don't use this platform to trade, and I have about 7 grand in it. But I just, I take all my trades off of Thinkorswim. I have no positions in First Trade. But you can open up an account here for semi nothing. Like for $200 or $300, they'll open up an account for you. And this tool is free if you're a member. And you can use it to your heart's content. And it's really, it's a small firm in New York City, but it's really reputable. And it has a very, very nice platform. If you ultimately wound up trading it, you wouldn't regret it. I can tell you that. And this options wizard is really excellent. Excellent, excellent tool. It doesn't give you quite the power of Thinkorswim, but I don't think you may need it if you're not an advanced trader. And I really like the way it gives you this check that says, hey, I'm the trade. It doesn't matter. And it's giving it to you on a July 31st. But you know that you can change that. All you have to do is modify and go back. And we wouldn't take the July 17s. Oh, this is July. Let's go to June. There's our June 10. Now, the maximum risk here is 836. The maximum reward here is $2,664. The probability of getting it is 33%, and it's a good trade. Now, it doesn't have that seal of endorsement, but if we go to the Greeks, the risk is 836 to make 2,664. The stock has to close on July 10th. Well, this is July. I wanted a shorter term, but it's a terrific trade. And this is a trade we could potentially take and hold just for a short period of time. We have an excellent delta. It's about $50, which is right at the money consideration. Gamma is small, $1.28 per day on average. Theta is also small. Near expiration, you're going to lose $12 per day. Not here, but towards expiration. See, per value as expiration approaches. Right here, you don't have a theta that high. Hey, Eric, are you going to cover? Yes, I'm going to cover diagonals and calendars, Eric, because I think calendars are terrific potential trades. I really like calendars. And obviously, a calendar is not something we're going to take on a daily. But if you want to take a more long-term trade, we're going to go over calendars. We're going to go over calendar positions. Like I said, they can give you a weekly, a bi-weekly, or a monthly paycheck by having that option you sell expire worthless. Every single week or month, that stock. And that's where, when you buy a calendar, when I said you have 4 directions, you have bullish and not bullish. If you're not bullish, that's where the calendars make big money, as long as you are not bearish or bearish. So when you're not bullish, your position is this stock's going to drift. It's not making a hard right turn north, but it's not going down. And as long as it doesn't go down, you make really good money on the calendar. So we are definitely going to go over those positions. I just thought it was a little bit too much because there's a lot of traders here that just are novice. But I will show you calendars, and they can be leveraged for really, really nice money. Hey, Dirk. No problem. Dirk, I closed my Caesars at 185%, and Dirk is still hanging on. And here's the Caesars. Now on Caesars, they recommend no vertical at all, at any price. And they're not giving you much here. The technical score is 6, it's neutral. I mean, listen, from my standpoint, you're up so much on it, Dirk. I'd close it. I mean, it's not at its high, and you can still hold, but the metrics you get here are not giving us a very good. Like we wouldn't enter a call here on Caesars Entertainment. And listen, I want you to make as much money as you can. You milked a lot more money out of this trade than me by hanging in there. I can tell you that. Hey, Najaf. Yeah, we're still using the Unorenco. The trading platform hasn't changed. This was only about options. The September 18 call, let's take a look. Here it is. Now look at that, very nice. The September 18 call is giving you a check as a best trade. The $12 call. I'm really shocked, but you pulled it out. Unlimited profit. The risk is only 92 bucks. This is a decent probability you win. You got a perfect delta at 54. Your gamma is not bad, and your theta is decent. So you got yourself a great trade here on the September on the September at the money. So what can I tell you? You may want to hold it on this basis. Now be careful with the technical score, but this takes into account this score and the risk to reward, everything. So it's telling you to go ahead and take it. 98 is a good number, and it's an optimal trade. So I take it back. Very nice, Dirk. Listen, Najaf, first trade I just recommend for starters because I like this tool. Thinkorswim is a little more complicated. In fact, it's a lot more complicated. I'm not going to open up my Thinkorswim now, but it's very complicated. And what they have is a Thinkorswim team that you can go to, and they will teach you how to use Thinkorswim. This is just, this is just very, very intuitive and very easy. Both platforms give you about the same commission, and they're both good brokerages. The only thing I like about Thinkorswim over First Trade, which I have to tell you is a big deal, is if you call First Trade up, you always have to wait 45 minutes to get a broker. If you call Thinkorswim up, you usually have to wait 5 minutes or less. And you can call Thinkorswim 24/7. And First Trade, you can only call about 7 o'clock in the morning to about 8 o'clock. There's like about an 8-hour period of time where you can't reach a broker. They can still take a trade on the platform, but I always like the ability to be able to call a broker. If for some reason I just have a little uncertainty. But I trade Thinkorswim off my phone, and I rarely call, but that's the only downside. They don't have the customer service that you would like. It's a little bit less. The $10 calls, Dirk, the $10 calls. Let's see. Here's the $12 calls. So you want a strike of 10. It doesn't even give it to us. The best we can do is a $9.75 call right here. It's the best we can do. Here's your $9.75 right here. And here's your not so great. Cost is 970. Max risk is 970. Max reward is unlimited. But if we look at the trade up here, very poor return. And the Greeks are probably going to be really lousy here. Just really poor. So that one I'm not crazy about. But I'm not going to do any more, Dirk, because I got so many questions there. Yeah, there's something like this in Thinkorswim, Raphael. I'm not going to open Thinkorswim because it's much more complicated. Actually, it has my actual portfolio, all the positions I hold, and also the amount of money I have in there. But that's not the reason I'm not opening it. I think for beginners or intermediates, this type of tool is better for you. And I can show you Thinkorswim. I'll be happy to do it. I'm not going to do it today, but I'll bring it over for you anytime, because you can open it independently of your portfolio. And you can see, if I put it in here, if I put in TOS, I have to put in Thinkorswim, I think. There it is. See, there's my Thinkorswim app. See, if I click it, it's going to open. I'm just not going to open it now. I guess we're going on 2 hours. Appreciate the insight, Mark. I still need to review this, and you're going to get the recording. I'll tell you, you're going to get very, very few webinars. Most of them are and I'm serious, and I'm not being overly cynical. They are tilted towards trading their gimmick. And this is not looking at trading anything specific. It's just learning how to take an optimal trade on a great entry and how to leverage it the best way. And let me tell you, there's more than one best way. The way that I'm going to recommend is always going to be the conservative entry. But if we take a day trade, we're going to close it that day. Hey, Peter. So do you use first trade and options play in your options trading? I don't. My complete strategy, Peter, I didn't want to put up here yet, because that's a lot. That's for the future. All I wanted to teach people, I mean, I had a limited goal here. If I did something like that, what Peter wanted me to do was show everything that I use to leverage to take a trade. Now, obviously, this is fundamental. I've got to have good metrics on the trade, but how I find them, and I'll just show you really quickly. I have to go here. I didn't really want to bring this up here right away, but I'll show it to you. One of the ways I look for great positions, now these are not day trade positions. I look at them through Benzinga. And Benzinga shows me every single options trade that's crossed. Now, right now, I'm not even looking at the options. These are just giving me the percent gainers and the percent losers, just as they cross the ticker. Now, I don't want to look at those. That's my watch list, and this has nothing to do with what I'm trading. I don't really use this watch list. So I have to retool my whole news feed, because my news feed, which is right here, I got it. These are all options. See Tesla. And this is really what I use. So let's say I want to take a trade on, you know, a much longer term time frame trade. And I'll take Norwegian, for instance. Is it NC? No, but I think it's NH. I block it out. NORW. Here it is. I'll put Norwegian up here, and it shows me all the Norwegian trades. If I hit enter, or I don't know why it's not doing it. Well, it's not giving me only the Norwegians. I have to reconfigure, and I played with it last night, but here they are. It's just giving me other information. You know, it's giving me Norwegian. I just want to see what other traders are doing on Norwegian. And when I took my Norwegian long, I saw a tremendous number of other traders taking positions in Norwegian. And this helps me on my swing trading newsletter. And it really gives me good trades. And so now cake, we got clear. And what I was doing was I took a position on cake. I saw enough people buying it, and I decided to go in on a vertical. I'm not thrilled about it, but it's got plenty of time. But that's what I use. That's not day trading, though. Hey, Robert, to figure out the price of the underlying stock, like I want to buy a call on blank when it hits. Listen, Robert, what you're going to do is if you're going to take a swing trade position, is I'm going to have to do another webinar on that. And I'll show you how to configure, say, a 3 or 4 or 5 or 6 or 7 month position. I mean, there's an art to do it. But the thing is you still need, and really my goal here was to keep it focused on understanding, because even if we take a longer term position, we're going to construct it based on the 3 metrics that are important to us. We want to create that leverage. If we don't create the leverage that we need on the position, there's no reason to create it or to buy it. Now, if we take a position that is a long way out of the money, like Norwegian, and what we are is not bullish, but in our long term, we're bullish. That's where you can keep selling your calendars, and every week, every 2 weeks, every month, collect a paycheck or collect money on it. I'm going to show you how to do that. That's why a long-term position can still be extremely lucrative. Even with a strike price at 2022, you can create a paycheck off that position every week, every 2 weeks. It depends upon the risk you want to take. That's where the calendar spread comes into play. I'm not going to read that, Robert. You're just giving me a hard time. Hey, Professor Mark, I came in late. Did I miss? No, Philip, this was not Forex. This was all options. And Redwood is a great tool for sure. It definitely is. It simplifies your trading, and you can modify things very quickly here. And you can play with it, and it doesn't take a lot of time. This is why I like it. Like if you go to modify here, we're already at modify, you know, you can go to 2, 3, 4, but you do basically you're going to modify at 1. You can modify your expiration date. This is only a call position. Here our strike price is 5. I don't think we want that. We're looking at Caesars. We want a strike of, I think it was 10. There's our 10 strike. There's our trade. Max risk is 286. And if we look at the metrics of the trade right here, it doesn't have a great score based on risk to reward. 55% is not a great return. And if we go to the Greeks, see, the delta is too high here. We're not leveraging delta the way we want to. It's too far in the money. So we're not going to get that hockey stick. We want the delta to be around 50 to 55. Theta is fine. And gamma is too small. We want to leverage gamma to push up delta. Delta is already too far up. And gamma is starting to tail down. I wish this gave us a gamma curve, but it doesn't. That's not a great position. That's why you don't buy deeply in the monies. Yeah, listen, I believe that one of the most important things is risk. You have to protect your downside. If 65 to 75% of your trades work and you protect your downside, you're going to make really good money. Hey, Ali, can you use the money flow program to fund? Yes, that's why I'm doing this. If we get a great entry, say we get a great entry on any stock, we get a signal to enter. We run over here and we put the price in. Well, we put in the instrument, Facebook. Now it's going to give us the best trades that we can take. Now, I don't know why we're not getting anything here. I just kind of screwed this up. This is going to give us the best way to leverage the entry we get off the money flow system. Because we need both. We need a great entry, but we need the best way to create that nice hockey stick. So if it, there it goes. It just clicked in. And look at that great trade. So we got an entry right now on Facebook. We've got a terrific entry right here. And here's the trade. It's expensive. And even though it's a vertical, it's gonna cost $1,235, but it's a 265, 235 vertical, and it's going to expire July 31st. That's telling us the best expiration and the best trade configuration we can get. We don't have to follow it. We can modify it, but it's giving it to us right here. This is how you leverage, and it's giving us a weekly for an expiration. What we have to do though, when we take the trade, is just check the bid ask. It's decent, it's a buck on a $200 stock. We've got nice liquidity. We want to enter at $11.85 and sit. And hopefully over the course of an hour or two, we're going to make nice money on the trade. We're going to leverage that hockey stick, and it's going to take us up nicely. If you want to buy the call, it's not quite as good of a position. This is the better position. And even though it's a 45-day, we can certainly modify that. But this is telling us what's going to make us the most money. And we're leveraging delta, theta, and gamma. Hey, Udayan, do we have to hold an account with options plays to use the table? No, you don't. Like I said, this position is taking into account your risk. Remember, your max risk here on just buying the call, and we can change the expiration. It's June 16th. And we can change the expiration to June 26th. So here's our June 26th options expiration. It's still giving you an at the money. Well, we would take we would buy the at the money at 235, which is right where it is. It's still giving us a vertical, but we're not going to use it. We're just going to use the call. And if we look at the metrics of the call, obviously it's really expensive. Expected profit, now this is at expiration, it's only 1 week, is $1,900. Our downside, if we look at the Greeks, is 1,515. So the risk to reward here is a little bit greater than 1 to 1. Our delta is right at 50, which is where we want it. Our theta is high because it's a weekly. And gamma is going to be high because it's a weekly. And so we could trade whatever we want. This is giving us the best. This is going to give us what we get if we buy an at the money call on an entry right here. Hey, Reginald. Right. You know, I'm not a big fan of credit spreads. I didn't have the time to go into it, but their configuration are not nearly as good as debit spreads. And eventually I'll get into that. KYW. Okay. KYW, did you say this is not a good trade since the risk reward ratio? Yeah, listen, this number up here, if I can go back to it, takes into account the probability of getting a winner, the technicals on the stock, and the risk to reward. And you can see it's haloed in red. So it's telling you it's not a great trade. Don't take it. It doesn't like this trade. What you want to take are the trades that are haloed. Bad trade. See, this is not bad. Buying the stock, only we're not looking to do that. See, there's no this is just 100 shares of Facebook. So it takes into account everything that you want on the trade, the technicals and all of the Greeks, and gives you a compound score. And that really helps. And you're going to see that it takes into account in a big way the risk to reward. The risk to reward isn't optimal. You're not going to get that halo around it. And when you get those ones with the check, the risk to reward is terrific. While the Greeks are set up really great. I mean, those are the trades we look for. And let's see if we push out the expiration a little bit. It's not I don't know if it's making it better. Let's see. Just jumping around. We don't really know what we're doing here. Should we only trade options with a stock or ETF that has? Yes, it's got to have good liquidity. For sure. If you buy a stock with bad liquidity, you're going to have trouble getting in and trouble getting out. And I've done that before, and my God, if I regretted it. I'm telling you the truth. The options makers will torture you to get in and to get out. You want that bid-ask spread. You have to check it. Now, a lot of traders look at open interest. They look at how many contracts have crossed in a given day. It is not good. This is your best assessment of liquidity. I mean, obviously, as liquidity gets better, the bid-ask spread diminishes. And you should see the bid-ask spread on some options trades where basically no one's trading them. They leave it up to the market maker to play around with your entry. So I don't usually do it, but if I take a trade on an option that I want to buy with a really lousy risk to reward, I'll put my trade in at the bid. That's the word. I mean, for me, it's the most advantageous price. and the price least likely that the market maker will hand you. I'm definitely not putting it at the ask. And if I put it in at the midpoint, the market maker, will play around with me. So I just put a limit order in at the bid. But the bottom line is you shouldn't trade a poor liquid stock. It's going to hurt you. We're going to use it next week. I mean, this was an aside lecture, Wahab, just to teach you how to use options and to give you a better fundamental understanding. I mean, I just don't want to call out a trade and you don't know why it's a good trade. I mean, if you don't understand, you're really not an informed trader. And I really want you to understand these metrics. That's all. Hi, Mark. Will we be trading the equity options or futures? No, equities. I tend to shy away from futures options. One, because of liquidity, axis, and another because we're leveraging a leveraged instrument. Futures are already leveraged. I don't want to add leverage to leverage. So listen, I think the hardest thing to trade when you're trading options is to trade an index, not an ETF, but to trade the SPY without the software, because really nobody really has a great handle on which direction these indexes are going to go over the long term. I mean, look how they're hopping around like crazy. I think trading a stock or an ETF is really good, and day trading a SPY or ETF is very good. Hey, Ellie, do you look at implied volatility when you buy or sell? I don't really, Ellie, because all I really care about, I understand what you're looking at. Listen, if implied volatility is really high, then the option is going to be very expensive. And so your inclination is going to be to sell it rather than to buy it. And that's something we can get into in a much more advanced lecture. But buying a call spread or selling a put spread gives you a whole different set of metrics. In terms of strike price, in terms of your gamma, your delta, and your theta. So my inclination always is to purchase. I'll take the hit, and so I don't really look at implied volatility that much because I'm not looking to sell. I mean, if volatility is not, listen, we leverage volatility this way. Like if a stock if we're holding a position and it gaps up 15 or 20%, it's going to skyrocket volatility. That's a great time to close. Like, and sometimes in our longer term positions, I'll say close at the open because we're already up a ton of money. I believe the stock is going to gap up strong, and that gap up creates this tremendous leap in volatility. Let's leverage the volatility, take it off the table, because once it settles at that price and stays at that price, you'll see the value of the option start to fall. So I mean, that's just my style, Ellie. And I'm not saying it's right or wrong. I'm just saying, I mean, that's sort of my style. I don't look at implied volatility simply because I'm not looking to sell. Hey, Peter, I have not looked at Tasty Trade. I haven't, Peter. And they may have an awesome platform. Hey, Reginald. Listen, they may give you a month free too. I have no idea. I mean, I've been with them a few years. I'm like I said, I just put a modest amount of money in there. It's more like a savings account. I mean, I don't risk it. I don't trade it. I just leave it there, and it'll be there for all time to come. Hey, Eric. I think that First Trade offers 0 commissions on options. Well, that's terrific. I mean, that's a great deal. They offer no commissions on your options. I mean, it's a good platform. It really is. The only thing I told you, the only drawback is their customer service is not as good as Thinkorswim. I mean, TD Ameritrade, I know 1-800-934-4448, hit option 3, hit option 3, put in your account number, hit pound, put in your PIN number, hit pound, and then hit 3. And you got to commit, and you got a broker. Pretty quick. I've been dialing that number for 20 years. It is called Options Play. Listen, it may be really good. Listen, I'm certainly not here to evaluate platforms. I just wanted to show you one that was very intuitive, very easy, and didn't have the complexity of Thinkorswim. And I think this gives you, I'm telling you, I think this gives you all the information you need to take a great trade. And you don't, and that added complexity doesn't give you a whole additional amount of information, unless you really, really want to trade more complex positions. Like I just closed a risk to reward where I bought a vertical and then sold a put. I told you, and the price of the whole thing was 0. And I had nothing to protect my bottom. Every position I sold was bullish. And if the position went against me, I was in the shitster. But I paid nothing for it. So I don't take many risk rewards, but you can't format a risk reward here. You can format a calendar, and I'll show you how to do that. I mean, when we move forward. Hey, Eric, you should mention that day trading options requires, yeah, it does require it requires $25,000 of day trade. You have to have that for day trading anything, stocks or options. Yeah, more than 3 trades a week. And we may very likely take 3 trades in one day. So they will not let you do that unless you have that money. Hey, you dying. Mark, you say a probability of over 30% is good from an options table, but this seems to be at odds with the probability of the way we take trades. I understand that. It's really simple. That's looking at the probability of a winner only at expiration. It doesn't look at any other metric. Plus, the metric that it looks at is static. So i.e., what is the probability that this trade is going to win given the current technicals remain unchanged? It doesn't look at any of the fundamentals. So let's say that we know on Facebook that somebody just purchased $25 million worth of call options on Facebook. Well, that's not going to show up in that risk to reward box. It's not going to show up in any change in the technicals. So besides these technicals, we have to leverage the technicals. And that's what we do when we trade off the money flow platform. We're going to get great entries that give you a much better reward than it's giving us here, because this is not looking at money flow and it's looking at all the technicals here as static. So I mean, I hope that I think I do have a meeting, but I have a webinar at 4. So I'm getting really tight here. Hey, K-Mac, great webinar. If I can ask you one, sure. It should be out today. I just talked to Sergio. Hey, Wahab. Yesterday I was on the phone with Toss for 47 minutes. Well, you know, let me tell you something. They're getting overwhelmed too. I have to tell you. Normally it's a quickie, but I have also incurred problems with them lately too, because of this volatility. You can wait up to an hour now because they're really overwhelmed. Great. I'm glad you enjoyed it, Eric. Hey, Jeff. I caught some of this. Seems very informative. But will there be a record? Yeah, you're going to get a recording. Absolutely. Hey, Ellie, can we receive the? Yeah, you're going to get the whole thing. Don't worry about it. Great insights. Thank you. We need to set up a funded account for next week to trade live with you next week. Thanks for all you do. I appreciate that, Mark. For those types of trades, do you get signal off a daily or intraday chart? Eric, these are all the things that we have to decide. We have to decide the time frame we want to trade in the battle room. We want to decide if we want to take a swing trade. I'm inclined to take a day trade. To get the entry, take the option, write it up, hopefully in that hockey stick formation, make 50% and close it out. Or else what we're going to wind up with is we're going to wind up with 2 or 3 open positions. Now they should be very, very advantageous positions, but I'm going to show you the way you can trade those positions. It's intraday. I mean, I want to trade intraday positions. You know, the profit target, JP, depends upon the cost. I mean, if we are going to, if it's going to cost us $250 to buy it, I want to at least take a trade that's going to give us $250 in profit. And that's what this tool tells us. It will approximate how far we have to go in order to make that much money. I mean, we want to eclipse our reward. We want to always eclipse our risk with our reward. So how far we go is going to depend on that. It's all recorded. What is the optimal time to trade? You know, any time during the day, JP, where there's good volume in the markets, we can trade. I mean, you know, if stocks are dead and flat, and it's 2 o'clock in the afternoon on some days, you know, it's bad to trade. I mean, this morning, I mean, the options were brutal and the stock market was going crazy. I mean, that's a good time to trade, except I'll tell you, the direction of the market led to this morning was up and down and up and down, the futures market. But in general, the overall trend was up. And that's what we're going to leverage here. Hey, Mark. Long butterflies and long condors. Listen, here's why I don't like them, Mark. They all have 3 legs. They're hard to get in and hard to get out. There's nothing wrong with them to take a 3-legged position, and they all have their place. But I think a vertical, a calendar, a call, and a put, I think those are the bread and butter trades you want to take. And that's just my personal opinion. I know a lot of traders do trade butterflies and they trade iron condors. There's nothing wrong with them, like I said. I mean, listen, I used to trade a lot of straddles and strangles on Google. And I used to straddle and strangle the hell out of it in 2004 and 2005. I just don't trade straddles and strangles anymore. So you know, that's just my opinion. Is there going to be a trade room for these? Yeah, there is, and I'm going to offer it to you. Hey, you, Diane, would you work with us on long condors and butterflies? Eventually I will. Or the money flow tracker offer us trading opportunity? Sure, listen, when you get a great entry, you can leverage it with any type of option strategy, you, Diane. So the one that gives us the best leverage is always the best trade. And if you think that a condor or a butterfly is going to do that for you, you can take it. I think that if you're going to day trade, you want to get in and out really quick with very little quote slippage, you don't want to pay the market maker much on the bid and ask. I think you're better off with a one-legged, buying a call or buying a put or buying a vertical. They're easy to get in, easy to get out. You buy a liquid position and you pay almost nothing on the spread. And that's just, my feeling. But like I said, options give you a lot of different ways to leverage it as long as you know what you're doing. That's all I can say. Yeah, okay, thank you, Robert. No, we're going to do Forex. Don't worry about that. Oh, my pleasure. Richie, I think you're really your bread and butter option positions is buy a call, buy a put, buy a vertical, or buy a calendar spread. Now, a calendar spread is not for day trading, but if you want to swing trade a position, a calendar spread can be very, very profitable. And they're really great. I mean, this COVID deal has really given us an opportunity to buy great calendars. And I'm telling you, I'm about ready to pull a trigger on a calendar on Dave & Buster's. Now, let me see how Dave & Buster's did today. Dave & Buster's is play. Now, obviously, play is in the dumpster. It's down 52 cents, so I'm not ready yet. But if we go back, if we go back 6 months, it was trading at 48 bucks. And we need a little bit more positive news on play before we can get in. But Dave & Buster's is a great company. I mean, a family that goes in there. Right now, no one can go in there because of social distancing. They blow $100. They buy a hamburger, a beer, and their kids run around with these $25 cards and stick them in these machines to play these video games. Right now, the stock is a disaster because of the COVID epidemic. But you've got to get in before there's major good news, because it's going to rocket this stock. So here's my position on Dave & Buster's. I'm not bullish. And that's exactly the kind of position you want to buy a long dated call. I might buy a January 2021 call and simply continue to sell calls against the position. And hopefully every couple of weeks to every month, my call will expire worthless and I'll get paid and paid and paid and paid. And eventually, when January 2021 comes around and I've already banked nice money, it'll move right through my strike price and I will make a lot of money on Dave & Buster's. If the COVID epidemic is good, you see you've got a bullish on the vertical here, and you've got a check. So it's giving you a great long trade. The cost it's 260 and the max reward is 590. That's a terrific risk to reward. It's almost a 200% reward. I just don't like this trade right now based on the fundamentals. So I would hold off on it. Technically, it's great, but I'm just giving you a little heads up. This is what I would look for as a great position to buy a long call and just keep selling calls against it and bank that money when your call expires worthless. Of course, I will call it out. I'm going to give you the trades. Hey, listen, we're going to do, I think we're probably going to do mostly calls and spreads. But remember, Wahab, a lot of traders are concerned about their risk. And you take less risk on a spread. But we're going to look at the metrics. Listen, these trades are not going to be moving so quickly. We don't have 60 seconds to take a quick look. So we're going to look at the risk to reward on the call and the risk to reward on the suggested vertical. We know our delta is going to be excellent. We know our gamma is going to be excellent. And we know our theta is going to be excellent. So it really comes down to a matter of, do you want to risk more on the call, or do you want to take a more conservative position by buying the spread? That's all. You know that your delta is the same, so you're going to make about the same amount of money. So it really, it's really 6 of one, half dozen of the other. What is it, CP? Rich, I'm not sure what CP is. I'll put it in. I don't have the set for calendars, but I will set it up. CP is Canadian Pacific Railway. You see, for me, this is, if you're looking at a calendar, for me, I like to trade calendars on beaten downs that are, that are just off the floor. And this just seems to me like it's got a long way down, and it's already come a long way up. I don't want to buy a technical score of 8 and a stock that's gone this far. It's a great stock. And if we look at the vertical here, we don't have it. It's not perfect, but see, 121% return is not great. Now we could push the time out. Whoops, went the wrong way here. Let me go to the trade, and we can push the time out here to September. Now the score gets lousier. So actually the short term is the better. So, I wouldn't take a calendar on CP. Okay, Peter. No, Peter. Remember, Peter was talking, TD Ameritrade has 0 commissions too on their options. They don't charge you anything for options. Remember, they get to hold your money. That's a major benefit to them. And you still, they still figure you're going to trade other instruments. And the fill is totally dependent upon the market maker. Has nothing to do with the broker. The broker just sends the trade in. What happens after that is totally dependent upon all circumstances in the market. What your entry is. That's it. The broker in no way determines your fill. I can tell you that. If that was the case and one broker got a better fill, you'd have 100% of traders at one broker and nobody at any other broker. So they don't. Oh, they charge 65 cents per contract. Well, Aslam, I thought if you're a member of Thinkorswim, they drop the commission, but you may be right. Maybe 65 cents per contract. I just don't know. I take them off my phone and I don't even ask. I just don't. Now, I just want to show you really quickly this. This has turned out to be 2 hours, and I'm really trying to I really want you guys to learn. Now, obviously, if you want my options alert newsletter, it's $97 a month. And that's where I'm going to give you the best trades I can find. And if you get the options alert, you're going to get 1 month in the battle room, and that's where I'm going to give you the live options trades on the fly. And I'll show you my last alert newsletter, which I sent out at my own peril. I'll show you right here. Now I just want to take this off the screen because I've got a lot of other stuff in there, but I'll show you my last alert. I'll show you what we're holding. I'll show you our track record, and I'll show you exactly what we got. I have to tell you, I take every trade that I recommend live, and I bust my case on this. To put it mildly, every night I sit and go over everything I get off of Benzinga to kind of tune me in as to what stocks are on my hit list and what I'm looking for to get in. All right, here it is. I'll pull it right over here. I'll show it to you for better or worse. I said we are rotating out of tech and moving into healthcare and consumer staples. Oil and gas exploration has run up too far too quickly. So here's what I recommended. Now, I recommended AbbVie, and we already closed it as a winner. I put it for a vertical on Costco, which is not doing, it's Mezza. This is a January 21 on Bausch & Lomb. And I love this stock. I think it's gonna be 25 or 30. It's a little too cheap right now to start selling calls against, but I'm gonna start doing that shortly. I shorted Atlassian and it is going down. I tried to get into the Spider oil and gas exploration on a bear put spread, and it just rocketed up. So I closed it by SMS text message. Now, here are our open trades. We closed out Freeport McMoWan for 76. Lajala is not an option. It's a biotech catalyst position. I closed out renewable energy for 47 cents for 47%. In the portfolio, I have Expedia, Inovio, Norwegian Cruise Lines, Intercept Pharmaceuticals, Smile Direct, which I should have sold. Boeing, I have a 140, 150 call. Boeing is trading at 200. So I'm just going to leave it in, and we'll get 100%. Twitter's doing great. AMC I already closed out. This must not be the last one. Visa's doing terrific. And like I said, AbbVie is gone. We already closed it. And here are our closed positions. I didn't add a lot of winners. I didn't add AbbVie. I didn't add a few others. We've got 15 or 16 or 17 winners, and I have 3 losers. And we've got some major home runs. Energy Transfer, 163%. I screwed up Home Depot. Caesars Entertainment, I took off the table at 185% that Dirk is still holding on to. This was the risk to reward. It's a 3-legged position. I took 250%. Actually, the amount of money we made was infinite, because if you pay nothing and you make $3 on the trade, you've made an infinite amount of money. So I just took 250. I could have taken 500%, and I just didn't. So I like our open positions. Our closed, this is already booked as a winner, which is not down below. AMC is already booked as a winner, which is not down below. Everything else is still in there. This is already booked as I think renewable energy was in there. Freeport McMoWan wasn't booked as an energy as a winner, which was not down there. And Lajala goes into the biotech section because it was putting out a new medicine for malaria, and it got screwed. So we got screwed. So these are completely different positions. And if you want to stay with me on these, it's up to you. I take them, but they're catalyst-based positions. And if the FDA approves their medicine, you'll make 200, 300, or 400%. The FDA does a scroogey job on us, we're going to lose almost 100%, and it did on Lajala. So that's my last newsletter. And I really do a lot of care. I'm looking seriously at Dave & Buster's. That's my next position. So that's the price, and you'll be in the battle room. And I will send you a creative. If you're interested, it's fine. If you're not, no big deal. But this is where you're going to get the best swing trades and calendar trades that I can find for you, based not only on the technicals, but on the fundamentals. And as God is my witness, I take every position in my own real money portfolio. And it's really bad because when I'm day trading, sometimes I get distracted because I want to look and see how my options are doing. I can look at them on my phone. And Thinkorswim has a great, that's one thing they do have, is a great phone app. I mean, you can close out positions on a phone app. But if I close out any position intraday, you're going to get an SMS text message alert. And you're going to close that position right where I close it. So that's it. I really hope that you really enjoyed it. I really wanted to make this educational. Okay, hang on. I'm sorry. Hang on. Hang on 1 second here. I'm sorry. Hang on 1 second. They're trying to sell me an extended warranty on my car. Even when the number's local, it's still junk. So that's where you're going to get my longer term trades. You're going to get my calendar spreads. And you can see I have trades there on Expedia. Expedia isn't expiring until 2022. I'm going to start selling spreads, spreading calls on it. It's so far up. It's going up too fast. And Norwegian, we had like 300%. I should have closed. But there's where we're going to take it now. And with Dave & Buster's, that's what I'm eyeballing. That's the position I think we're going to immediately start as a calendar spread position. We're going to buy a long-term dated call and just keep offsetting it by selling calls. And I don't know how short-term I'm going to go, but I want to get a decent premium. You know, we're not going to make $1 million on them, but we're going to do them over and over and over again. Okay. I can't read half the things that Robert puts in there. I can't read. He loves me more than anyone. Only one. Then they call. He does call us every day, Robert. I tell you, 10% of our customers call us 95% of the time. And we have people who call us like 93 times a day. But listen, I only have. No, I think I know who he is. No, I like that, Robert. You're definitely politically correct. So listen, I hope you really profited from this. You're going to get a creative. It's going to have the link in it. Everyone in this room is going to get it. You'll also get an opportunity if you want to come aboard for the options. If you don't, no problem. I just threw it in there. It's cheap, and I bust my case on it. If you want my options trades, and remember, when I put out an alert, it's after hours. I am not in it, and I get in at the same price that you do. I do what everyone tells you not to do, and that is don't put in a limit order. Just put in each wing, and so some get filled and some don't. We either all get filled, basically, or none of us do. So listen, everyone, thank you so much. I really appreciate it. I know, Robert, we love you too. We do. So everyone have a great afternoon. The battle room will be back on next week in our normal format, and we're going to be trading. And you guys know now, as informed traders, what we're going to be doing. And I'll show you exactly how I do it. So I appreciate it. Thank you very much, really. And listen, this is just one of a series of webinars I'm going to give on options trading. We're going to get more and more complex. And if you're in the trading room or you're in the battle room, you're going to get this webinar for free. Nobody else, just you guys. So everyone have a really great afternoon, and I will see you next week, or I'll see you in the morning. Take care, everyone. Have a great day. My pleasure. My pleasure, Louder. Thank you. Hey, Rory, did that go good or